Today, Dow futures have surged by over 100 points, suggesting a promising start for the market following last week's impressive rally driven by technology stocks. As traders prepare for a week filled with significant economic reports, the focus is particularly on upcoming inflation data, which is expected to be pivotal. In addition to inflation, discussions surrounding tariffs and the ongoing speculation about potential interest rate cuts by the Federal Reserve continue to influence market sentiment. Notably, tech giants like Apple and Nvidia are showing positive movement in pre-market trading, which is helping to keep major indexes close to their all-time highs. Despite some geopolitical tensions and new tariff developments creating uncertainty, investors appear ready to embrace risk as the trading week begins. Here are 5 key points to consider before Wall Street opens its doors. 1. Anticipation of rate cuts. The Federal Reserve is widely expected to initiate a series of interest rate cuts starting in September 2025. Major financial institutions, including JP Morgan, predict that there could be around 5 reductions in this cycle aimed at stimulating the economy, especially as signs of a cooling labor market emerge. Traders have already begun to factor in a strong likelihood of a 25 basis point cut in the upcoming month, reflecting growing confidence that the easing of monetary policy is imminent. 2. Mixed signals from inflation data. Recent inflation statistics from the United States have presented a somewhat contradictory picture. While consumer prices have seen a slight uptick, partly due to tariffs, many economists believe this is a temporary phenomenon. They point to underlying trends indicating a decrease in price pressures, which could provide the Fed with the flexibility to lower rates without triggering another wave of inflation. 3. Job market concerns. New data regarding employment suggests that hiring is slowing down, with unemployment rates inching upward. This trend raises concerns about the sustainability of economic growth, potentially prompting the Fed to consider rate cuts sooner and more aggressively than previously anticipated. Investors are particularly attentive to the significant economic reports scheduled for August, especially those related to inflation and employment, as these will heavily influence market expectations and the Fed's future actions. 4. Impact of geopolitical factors. Ongoing geopolitical tensions and trade conflicts continue to affect the atmosphere on Wall Street. The latest tariffs and their implications for prices and corporate profits have added complexity to the Fed's decision-making process. Should the incoming data indicate that these costs are contributing to inflation, policymakers may adopt a more cautious stance. Conversely, if the effects dissipate quickly, it could pave the way for earlier rate cuts. 5. Positive diplomatic developments. Recently, markets have shown signs of recovery, buoyed by optimistic diplomatic discussions. A significant upcoming event is the meeting scheduled for August 15th between Trump and Putin, where they will discuss potential resolutions to the ongoing conflict in Ukraine. This news has alleviated some of the typical geopolitical anxieties, allowing investors to feel more secure in taking risks. The positive sentiment is reflected in the gains seen across both U.S. and Asian markets, as traders hope that these talks could lead to a de-escalation of tensions and foster global economic growth. But here's where it gets controversial. Are these rate cuts truly the solution to our economic challenges? Or could they lead to unintended consequences? What do you think? Share your thoughts in the comments below.